Hey everyone, welcome to the KE Report and a daily editorial on Tuesday, June 24th, chatting with Darrell Fletcher. Darrell is the Managing Director of Commodities at Bannockburn Capital Markets. Darrell provides me on a monthly basis with more of a commodities trading desk perspective. What he's seeing in terms of positioning, price moves, forward curves, all the things that matter to active traders and those trying to manage commodities exposure in the main sectors such as energy and copper, as well as we'll even touch on gold. So, Darrell, it's been a month since I last had you on. We last chatted May 27th. Let's talk about just what you've seen in the last month. Provide us a little recap. What's caught your eyes in terms of commodity moves?
Yeah, sure. Thanks, Corey. It's funny, a month ago we were talking and starting to say, well, things are slowing down so much for that, slowing down, that things have changed vastly in the past few weeks, mainly on the energy front. But yeah, just I do like to level set and look at broader commodity indexes too. On the 1 month, really the broader commodity indexes, are flat to higher, depending on if you're looking at a spot index or SPGCI. The gains have all been in the energy sector, even though we've had this huge sell-off the past 2 days, with the energy sector up about 5% on the month. Base metals are up about 1%, kind of flat. A lot of that's been in aluminum. Like I said, energy's up about 4 or 5%, and then the broader indexes, depending on which index you look at, are all in that, up 1% to 5% space. Gold's been flat this month, which is interesting, especially given the circumstances. And we touched on it earlier. Silver is up about 6% on the month, and it looks to me like it's kind of playing some catch up to gold. And yeah, the dollar has been down about 1%, not huge, but that dollar index continues to grind lower. So bit of a mixed bag, except for the energy space, really.
Man, let's get into the energy space because oil has been on a wild ride. As we were chatting last month and the month before, we were talking about the breakdown in the oil price below $65 a barrel. And quite frankly, just how, I guess, weak the chart looked over the last year, two, actually 3 years. But then we had these tensions between Iran and Israel, war escalations, and boy, oh boy, did that move the oil price. So, crude entered this month right around $62 a barrel. Recently spiked as high as 75, almost $77 a barrel on the back of even the US launching some rockets into Iran. But now we hear of a ceasefire and oil is back below 65, all in a matter of a couple days. Darrell, from a commodities trading desk standpoint, what do you even see in these charts? What do you see in this market when we see these sort of crazy swings all on the back of geopolitics?
Yeah, it's been a wild ride. The 2 day move here in crude down about 13, 14% now, WTI basis, and in the diesel market just slammed. We haven't seen those kind of moves, since 2020. So it's been a wild ride. The ceasefire, kind of call it a wobbly ceasefire for now at least, is why we've had this big reversal. To your point, we kind of ended the week last week around 75. We had another spike up over the weekend on the open, but it was quickly shot back down. And then, so that whole risk premium, especially in times like this, I like to look out the forward curve at the 12-month spread. That risk premium, that whole part of the forward curve has been flat out there at 62. It only moved to 65 when the front was moving up $10. So that steadiness in the 12-month spread is really interesting where it was sitting. So you had late last week about an $8, $9 risk premium that was just not just, but it was due to the risk of the war situation, and in particular to the Strait of Hormuz. But that has completely subsided in 2 days here. So it's been interesting. Again, we talked about this last month. The market was around that 60, $65 range, basically break even for US, depending on the basin you're in, 55 to 60. But it's been steady. I mean, the forward curve now, 12 months out, you're right at 62-ish. And it really didn't move that much this past week. So that's a good reflection or a strong reflection of the fundamentals being weak, really. And nothing changed fundamentally. It was this risk premium.
This is what I find so interesting. We had an energy guy on the show last week, and he does lean on the bullish side of oil and natural gas. And he even made the comment when the war escalated there that he thought that could have pushed oil up into the triple digits, but it only got into the mid 70s. That to me speaks volumes because look, war did escalate in this area that can impact energy prices, especially the oil price. And yes, it popped, but it's already given up most, if not all, of those gains. And quite frankly, it's already back below that $65 what was support level. This just to me means that the oil market could be weak for a while longer. Darrell, what do you think? Am I off base here? Could we recover in the oil price?
No, I think I really agree. It was like what we were saying about this 60, $65 range just being a complete anchor out there. It hasn't changed. Look at, when you have these kind of moves where, it's just a lot of risk and uncertainty on the table, you kind of look back to, okay, what have we seen most similar? I think I said this last week in my weekly write-up. No two geopolitical events are near the same. But if you look at the Russia-Ukraine war situation, where we spiked up to around 123, 125 a barrel, yes, that can happen. But you were starting from the 90s. Your forwards were in the 90s. So on a percentage basis, it's just, those $100 people like to talk about $100 oil, but you have to look at where you're starting from. So we are anchored here around 60 to 65. Fundamentals are bearish. I mean, we're probably going to be looking at a global surplus in 4Q. Global supplies have grown 170 million barrels in the past 100 days. OPEC production has been increasing. So, and demand's just not there like it was. So, this anchor is still what it has been in the 60 to $65 range.
One thing that I was reading recently was a Dallas Fed oil and gas survey in March that showed the break evens for US shale and non shale onshore drillers. A lot of these break evens are at the lowest level, $61. That's in the Permian, Midland area. And then from there, it goes up to $70. Other Permian producers with the oil price where we're at in the mid to low 60s, do you see US production coming offline because of these lower prices?
Yeah, I've always generally believed, yeah, to your point, like the basins can really differ, but 60 to 65 is kind of like a good rule of thumb for me. And yeah, I mean, U.S. rig counts have been have been falling off steeply. I think we're almost like a 4-year low on U.S. rig counts, the Baker Hughes rig counts. So yeah, you're definitely seeing that. And actually that kind of was bleeding into a little bit this kind of overdone natural gas move with the associated gas, with the rig counts coming off, especially in Permian. You have an associated gas there that's going to be shut off too. So that was a little bit of the move in the natural gas space. But yeah, I'm kind of sticking with where I've been all year on crude and that, you know, range to lower, which we've seen, and that's where it is, and that's where the forward curve is pointed to, and it's been really anchored there.
Okay. Yeah, enough said. Hey, the market's even telling you that with the forward curve, and quite frankly, this bounce and now very quick correction telling us that oil still might be under some pressure. What about natural gas? The natural gas market's been, I think, relatively boring. It's not in the $2 range, more around 350 right now. But fact of the matter is, we're not seeing a ton of volatility in this market. But we are hearing a lot about LNG terminals starting to come online, or at least coming online in the near term. What's going to drive natural gas? And is it a different story for natural gas over oil?
Yeah, natural gas was kind of boring. We've had a decent move up in this July contract in the past few weeks, but it has really kind of subsided back. You've had a convergence. July got over $4, which seems a little overdone. Huge heat wave here, eastern United States, well above normal, and it's subsiding already in the next few days. So we saw natural gas fly up to $4, but we had a cash price that was at some days was $1 below. So you're like, okay, something has to give. You can have a cash price $1 below the front month that's coming off. In fact, the front month comes off this week on Thursday now. July will roll to August. So that did converge. It's kind of what I thought would happen. We had cash prices move to like 350-ish over the weekend, which made sense for power load for AC. But you've got this convergence now. July's come back off to 355, starting to match up with the cash price. The 50, 100, and 200 day moving averages are all in this 345 to 360 range. So that's where it's settling. August will come on the board this week, 360, 370. So we've kind of converged there. Again, I like to look at forward curves, as you know, and the anchor out there right now is calendar 26 natural gas, which has been and continues to be right around 440. It's been in that spot for a long time. And yeah, a lot of that is reflecting LNG flows expected to and already starting to pick up.
What about these LNG terminals? What impact do you see these having in the near term, or is this still a year or two out when we have even more of these facilities online?
Yeah, a lot of it has already started to come into play, and I haven't looked at the most recent schedules, but LNG flows were down a little bit in the past month, but they've gone back up. We're back up to like 14.7 BCF a day again, and we had been floated down there for a while in June, so that's helped. Let's pick back up. I think a lot of this stuff's coming online, 4Q and into 1Q next year, and I think you're starting to see some of that pick back up for sure. Now we were below 14 BCF for many days in June, and it's just picked back up here.
Okay. So is this a balanced market? Is natural gas right now fairly balanced in your eyes?
Yeah, right now, yeah, it does look really balanced. I was looking for this front month to come into line with cash as we get to expiration, and it has. And like I said, the moving averages, all the technicals are kind of pointing in this range, and it looks pretty balanced here. So, you have all your wild cards. Geopolitically, if nothing else going on, you could have big moves across the energy complex. And you're coming into hurricane season here too. So that's always a wild card that cannot be predicted, but we're out there now. Like we're starting into it here soon.
It's true. You always have to watch the weather for natural gas, but yeah, right now it's actually been, well, way less boring than oil, especially this month. Boy, oh boy.
Yeah.
Let's also talk copper. Copper is holding in there fairly well. You and I keep talking about how copper is broadly repriced in this $4 plus environment up to $5 and change, and right now it's just below $5 a pound, and copper isn't overly exciting, but you do look at some of the short term charts, and I still see a bit of an upward bias here, but a pretty defined ceiling as well. So, what are you seeing in the copper market?
Yeah, it's been steady. This we talked about that last month. It really has reset, from the call it historical year lows or historical averages, I would say, for the past few years. And it's held really well. Front month's 480, 490. The COMEX curve is in contango going out about a year into, 520. So the big story in copper right now is this reduction of LME inventories and all the flow coming into COMEX. So it's an odd time where you have the the LME copper forward curve is backwardated with the cash to 3 month hitting like 280 a ton. The spot to 3 month of backwardation. That's really rare because you've had a lot of this physical copper flow come out and come into the US ahead of anticipated tariffs. So you have about a 50, 60 cent difference in the 3 month LME with COMEX being over that again. So it's been an interesting physical market, but to your point, everything's still, in that high four range. If you look at that calculation, if I have this right, in the 3 month COMEX to LME, you've got is it about 1,000 a minute? It's pricing in about a 10 or 11% tariff for 232, and that hasn't come out yet. That's what it's pricing in right now.
That's interesting. I was going to ask you, what are the tariff implications there? So, how do you do the math on about a 10% tariff? How do you say that it's pricing that in?
Yeah, I think my math out. You look at the differential of the LME and COMEX out at the same time frame, and you come up with that differential and what the price is over that. And I have to look back through my math, but I'm coming up with about 10 or 15% is what the current market's pricing in.
Okay. Well, what have you seen in the major copper stocks too? Some of the big boys. Freeport was really selling off over the last year now, but has started to rebound.
Yeah, the major copper stocks, some of these are gold and copper. They've started to rebound finally and have some good gains. If you look at BHP, COPEX, and Freeport, they've all finally gotten some footing beneath them. So that's good to see. I think Freeport's up about 10% year to date.
They were under some pressure though. Hey, these things were in a bit of a downtrend for the last year.
Yeah, and you've got COMEX copper up 20%. So, it's about half of the move.
So how do you view that discrepancy then? When we see the stocks, especially the big guys, in a way underperforming just what's happening to the underlying metal? Is that because of geopolitics or tariffs, just different type of markets that impact the metals compared to the actual stocks?
That's a great question. If you let's look at Freeport. So Freeport call it up 10% year to date. LME copper up 10% year to date. COMEX copper up 20% year to date. So that's clearly also a good representation of that tariff flow coming into the United States, trying to get ahead of these tariffs. So COMEX copper premiums up 20%, you're up 20% year to date, and LME's half of that, and the equities reflective of that LME move, 10%.
Okay, let's look at the precious metals then, because gold continues to be relatively flat, more or less range bound over the last couple months, but hey, it's range bound at historically high level as well. Silver and some of the other precious metals like palladium and platinum playing a little catch up over the last month. Some of that momentum has slowed, at least in the last week, but boy, oh boy, there was a trade there where silver, platinum, palladium playing catch up, and even those underlying equities were really playing catch up to the gold stocks. What are you seeing in precious metals land?
Yeah, so for the month, like I said, gold's flat, silver is playing catch up, looks like about up 7%. Platinum's up 21%. But there is a physical shortage in its usage too, which is reflected there. But gold, yeah, you had a good point. I mean, gold's holding near these historic highs. You're up 20%, 26% year to date. Silver's up about 24. And like I said, it's played catch up. I'm still generally really positive on gold, just with all the risks and the debt situation. We peaked out in that 3,400 plus range, and you definitely consolidated. But as the bank reserves and a weaker U.S. dollar, I wouldn't be surprised to see the Fed start to cut here maybe in September. I'm kind of more on the 1 to 2 cuts, but who knows? I think we see a weaker dollar. So I still like gold. Yeah, it's definitely consolidated and flattened out here, but again, at historically high levels.
Yeah. Oh, and you even look at that chart. Yes, gold hasn't been able to break back above that 3,500 level that it hit in April, but higher lows. It's forming tighter and tighter range that it's trading in. So who knows? There could be a move coming in the next couple weeks or couple months, which it's over summer, which is not typically the time that gold makes a move. How do you view silver though, as a precious metals trade? Look, we don't have central banks buying silver, and silver is such a smaller market than gold. It seems to be able to move quickly, but at the same time, any spikes over history, especially major ones, seem to mark a top in that market. We haven't seen those type of spikes in silver yet, but we have seen a better environment. So, as a commodities trader, running a commodities trading desk, do you pay much attention to silver? What are your thoughts on that metal?
Yeah, that's a great question. I kind of look at it less occasionally, but this catch-up move kind of caught my eye in the past month. Yeah, it's not the best proxy for precious metals, relative to gold for sure, but it does have some utility, industrial utility, less than gold for sure. I mean, more than gold for sure. And then you get into like platinum and palladium, even have more of a utility in the industrial use side. So, relatively speaking, it's not going to, be a pure play like gold, and it looks like it's just playing catch up right now.
Okay, one other market that I want to ask you about because it can impact commodities. That's currencies, especially the US dollar. The US dollar has been under some pressure. Usually that means that it re rates or at least reprices commodities broadly higher. What are you seeing in the dollar and its impact on the commodities sector?
Yeah, that's a good question. The correlation, the straight type correlations just aren't there like it used to be right now. So year to date, dollars down, okay, you call it 9-10%. And the indexes, the broad indexes and commodities, let's call it up 3-4%. So it's been a big move in the dollar this year. And I think the rate cuts are starting to get priced in more and more here. And the new budget situation with the debt situation doesn't look very promising, in my opinion. So a little bit of a breakdown. Gold again up 26%, dollar down 10%, directionally right, but it's not near the correlation I think maybe some of the longer term history would have showed.
Yeah, well, you're not alone in not liking the budget. A lot of people are not happy with the budget, but who knows what changes we're going to see to it when it finally does get through. But yeah, right now, that story remains. The U.S. still running a very high deficit. Gold has been a major beneficiary to that. And as I said, it's really correlating or consolidating at these higher ranges, getting ready for some sort of a break. We'll see which direction it is, but hey, Darrell, always great chatting with you. We'll chat again next month. Again, Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. Thanks for your time today, Darrell.
Thanks, Corey.